Hello, and thank you for watching another video that I hope will provide some information and help overcome some misconceptions that you may have about the FHA Hybrid Arm Loan. Thanks for watching, and I think you'll find that most of what you think you know about the FHA Hybrid Loan is just plain false. It's wrong. It's no fault of your own. But if you will take the next 5 to 7 minutes to watch this slideshow in its entirety, you'll be very amazed at how little you actually knew about this product and how much you're probably going to want to learn about it. So let's get started. First of all, what do most people think about the FHA Hybrid Arm Loan? Chances are that you're going to have a lot of these thoughts or misconceptions. First of all, most people think these are unstable and scary loans. Most people think that rates can go up real fast and that they can go up very high. Most people think that when rates do go up, that automatically makes the mortgage payment go up with it. Higher rate must equal higher payment. Most people think that the 30-year loan is a smarter loan. We hear all the time people saying that ARM loans only work if you plan on moving or selling your home sometime in the near future. I love it when people call their previous loan officer. Normally they do not work for us, and they start asking them questions, and right away that loan officer tells them, don't ever do this type of loan. It's such a bad loan to do. And then ultimately the one that I think is the most characteristic misconception out there is that these ARM loans, specifically the FHA Hybrid ARM loans, caused the housing collapse and led to the recession, and they're just plain bad loans. I'm going to help you overcome all of these misconceptions today with facts. Not media spin or Wall Street fear tactics, but actual facts. So please keep watching as we go here. First of all, let's talk about the first one. Hybrid ARM rates are scary and unstable. Kind of reminds me of that game Jenga. You know, at some point it's just all going to come crumbling down. Well, that's not the case. First of all, FHA hybrid rates are fixed for anywhere between 3 years and 7 years. That's 36 payments at a minimum, up to 84 payments. That's the minimum amount of time that they can be fixed. It could actually stay fixed longer than that, depending on what the market does. Another thing, let's talk about stability, okay? This is an unstable picture. We want to talk about stability. These loans are all derived from the CMT index. That is the U.S. Treasury. It is a very stable index, and it is one of the safest and most stable indexes out there. We do have some other videos that dive into much more detail about indexes, but just keep in mind, these loans are tied to something very stable. There is a lifetime cap of 5%. Unlike other hybrid loans out there, unlike other ARM loans out there that are not hybrids, we've seen rates in the double digits. Okay, there is no lifetime cap, or if there is, it's extremely high. There are also annual caps, which basically, as we've talked about in other slides, do not allow your rate to rise ever more than 1% at any given time. That's the maximum that your rate can rise in 1 year annually. Okay, it can also only rise and fall 1 time per year. Many other ARM loans out there that have caused people concern can change every 6 months and can go up much more than 1 point at a time. We're not talking about that sort of an ARM loan when we're talking about the FHA hybrid. Now, as this picture depicts, many of you think that ARM rates can rise very quickly. As I just suggested in the past slide, rates, first of all, are not going to rise during your fixed rate period, and you get to choose. All the power's in your hands. Do you want to fix your rate for 3 years, 5 years, or 7 years? Your choice. Once you do choose that fixed rate period, keep in mind that rates can only go up 1 time per year, as we just talked about. They're not going to go up quickly. There's actually never been a time, ever, since 2004, where interest rates rose on the FHA hybrid loan 1 full percentage point every year for more than 2 years straight. That happened once, okay, in the last 10 years. It's not that likely. And again, we're talking about how quickly can your rates rise. They can never go up that quickly. Something else we hear all the time, when rates do go up, your payment automatically goes up. Now, generally speaking, I am here to tell you this is generally a true statement. It's not always the case, and you have a lot of control over whether or not that's going to happen. What will normally not happen, however, is that when your interest rate does start to go up, your payment will not go back up to where it was if you would have stayed on your 30-year loan. For example, a lot of the people we're talking to these days are currently somewhere around 3.75, 4.25, 4.5 on their 30-year fixed rates. FHA even higher, 4.75, 5%. Well, let's just assume you chose a 2.25, 3-year hybrid. And then 3 years went by and you went up a full point to 3.25. You're still significantly lower on your interest rate than you would have been had you stayed at your 30-year fixed rate. Even if it goes from 3.25 to 4.25, you're now just starting to get back to where your current interest rate was at the time of refinancing. And because your balance has been paid down so much quicker on this ARM loan, even by going back up to 4.25, generally speaking, we have seen your your principal and interest payments at year 5 with a 2% increase in your interest rate over year 4 and 5, you still don't get to where you have a mortgage payment that exceeds or even meets the payment that you would have been had you never refinanced. If you need to rewind this and watch those 3 bullet points again, slower, feel free. Something else you need to realize, it is possible with a little bit of coaching from us and a little bit better understanding that you could accelerate the rate at which you pay down your loan to where you pay it down so much that even when rates go up above where you are today, should that happen, you could potentially at that point in time still have a lower payment than you did the year before, or especially than you did when you were on your current 30-year fixed loan. Again, that's going to take a little bit more coaching from us and a little better understanding, but many of our clients have taken this route. Let's go on to a little bit more simple slide. Many people think, and I hear this all the time, well, the 30-year loan is just smarter. My parents had it, and their parents had it, and their parents had it. Well, that's probably true, because the 30-year fixed rate loan is a very old-fashioned loan. We'll talk about that here as we go on. Right now, most other industrialized countries don't have near the prevalence or reliance on a 30-year fixed rate that we do here in the United States. You can make whatever deductive conclusion you want from that, but I'm going to tell you it all has to do with Wall Street and, in some cases, greed. But we'll get there here in a second. Here's why. Whether you want to compare yourself to other nations or not doesn't really matter. The fact is, most homeowners in this country are not in their loan for more than 3.2 to 4.7 years on average. Now, we didn't just invent this data. You can go research it on your own. Just look for information on the Fannie Mae or Freddie Mac statistics about average time in a loan in the United States, or life expectancy of a 30-year fixed mortgage, something like that. You will find different data and different graphs, but realistically, this is the facts. We do not stay in a loan for 30 years. I mean, how many people do you know? Start asking. Ask your family members, ask friends, ask coworkers. Do you have a 30-year loan, or do you know anyone that has a 30-year loan and they paid on it for 360 months until it went down to a zero balance? When you think of it that way, it just seems somewhat comical. But the fact is, we all think this. We all think the 30-year loan is just so smart. Now go talk to someone that's in commercial real estate, or someone that works on Wall Street for a living. Your Jim Cramers or your Warren Buffetts, people that understand financial instruments. Most of them do not use 30-year fixed loans when they're buying their homes. Of course, a lot of those people buy their homes in cash, but the fact is, even real estate, when it's being developed, construction loans, commercial loans, most of these people do not use 30-year fixed rates. Why? Because they understand that construction loan is going to be paid off before 30 years. They understand that the commercial loan is going to be refinanced every handful of years because it makes sense. But unfortunately, they don't want the consumer, or for some reason, which I have not figured out, they have not educated the normal homeowner or consumer in this country on how to intelligently use adjustable rate mortgages that are out there. And again, I kind of went out of order here, but seriously, just ask around. I challenge you to find someone that made 30 years worth of payments without ever refinancing their loan one time. I've never to this day found someone that can answer that correctly, or not correctly, but honestly, and say yes, I did. Okay, so here's another one. ARM loans must only work for people that plan on moving. Most of us confuse how long we're going to be living in our current home with how long we will be living in our loan. This should say our. We like to keep it real here. Shoot from the hip. These are not scripted. I'm going to actually fix this quickly. Okay, here we are back. Most of us confuse how long we will be in our loan. As I've suggested, most of us are going to refinance our mortgage once every 3 to 5 years on average. We're either going to put on a new roof, so we've got to do a cash out refinance, or a home improvement loan, or we're going to be paying off our credit cards, or interest rates are going to go down. Something's going to happen where we either refinance, or we sell our home, or we move, we do something. This goes back to that Fannie Mae, Freddie Mac statistic. So thinking that it's only going to work if you're planning on moving is just an incorrect way to think. Now, Wall Street loves pitching us the 30-year fixed rate loan. Why is that? Because they can make anywhere from 1 to 2, maybe even 3% more in interest payments every single month, knowing all along that you're not going to be in your loan for 30 years. So why not secure yourself a much lower rate and pay a heck of a lot less interest? Well, again, it's because we have misconceptions and we're confused. Now, your past loan officer may have told you not to do the hybrid arm loan. I apologize that we're cut off a little bit here at the top, but here's why your current, or I should say your previous loan officer told you not to do this loan. Even though FHA loans do not have a prepayment penalty, most loan officers have to pay back a portion of their commissions, or the company they work for takes a penalty if you refinance that loan they gave you just a handful of months back too early. Just test it out. Try calling your last loan officer within about 6 to 8 months of closing on the loan and ask them if they'll refinance you. Even ask them if they'll refinance you into a fixed rate loan. They're not going to do it. So 9 times out of 10, they try to talk you out of doing a hybrid loan if we're getting in touch with you recently after having got a new loan. And also, one other thing, most loan officers out there have the same misconceptions you do. It's not their fault. It's just that most big institutions, as we've mentioned, they want you thinking that the 30-year fixed rate is the best loan out there. They make more money on it. When they sell this paper to Wall Street, generally speaking, the big banks are willing to pay a higher premium for 30-year fixed rate notes than they are the short-term adjustable rate notes. We're almost finished here. Most people think that the hybrid arm loan caused the collapse, the housing collapse, and the mortgage meltdown, when in all reality, the hybrid loan did not cause it. That's 100% false. Government arm loans actually went down over time during the housing collapse and recession. And your loan officer, if you call us, can send you some hard evidence of that. Those people that were in the hybrid arm loan actually had an easier time making their house payments if they stayed in their arm. The toxic arms, not backed by the government, but offered by Wall Street, actually played into the collapse of the housing market. These were loans that you only had to make interest-only payments on. There were even some that you could defer your interest. They were called pick-a-payment loan, where you could pay less than interest only. Liar loans, where you could state your income, state your assets, and not even have to turn in any documents. You just basically said, give me the loan, and they gave it to you. These are the loans that caused the housing collapse, not government arm loans. And again, your loan officer can provide you some hard evidence of that by comparing these two loans. Please give us a call. Stay tuned for more videos at FHAHybridTruth.com. You can also visit us on low VA rates and then scroll to the FHA Hybrid videos page, or call us toll free at 657-2848. Thank you.